Okay, so let's jump right in. It's been a wild week in the markets, right? Like every day there's another headline that makes you go, wait, what?
Definitely a roller coaster.
And today we're using this report from Market Deep Dive to break it all down.
Yeah, they do a great job summarizing all the major events.
Exactly. It's like our roadmap for this deep dive.
Love that roadmap.
So we're going to hit the US, Europe, even some emerging markets.
Buckle up.
Seriously.
Yeah.
So first stop the US. The jobs report blew everyone's expectations out of the water, right?
256,000 new jobs added in December.
That's insane.
Ah.
Way higher than anyone predicted.
Yeah, you'd think the market would be popping champagne, but...
But that's where things get kind of weird, right?
Yeah, this is where we see that sometimes good news can actually spook investors.
Okay, explain that one to me.
Well, the market's immediate reaction to this jobs boom was worry about inflation.
So too many people working, making money, spending money, that could make inflation even worse.
Exactly. And if inflation keeps heating up, the Fed might have to keep raising interest rates.
Which could slam the brakes on the economy, right?
Potentially. And that's what spooked investors. It threw a wrench in their plans. The market hates uncertainty.
So this jobs report, while good news for the economy in general, created this huge wave of uncertainty about the Fed's next move.
Exactly. And you saw that reflected in how the market reacted, especially tech stocks.
Oh, yeah. The NASDAQ had a rough week.
That was a direct response to those renewed inflation fears.
Okay, so as an investor, what am I supposed to do with this information?
Well, the big question is, what will the Fed do next? Will they continue raising rates aggressively? Or will they ease up a bit?
And nobody knows for sure.
Right. That's the uncertainty that's driving the volatility we're seeing.
Makes sense.
Yeah.
So U.S. strong economy, but inflation worries, and a Fed that everyone's trying to read like a tea leaf.
You got it.
Okay, next up, let's talk about something that always seems to add fuel to the market fire. Politics.
Oh boy, yeah.
Specifically, all the back and forth about Trump's stance on tariffs.
That was a classic example of how just the words of a politician can directly impact market sentiment.
One day, there are hints that he's going to ease up on tariffs, and the next day, nope, not happening.
And the market reacts instantly to every single headline.
It's exhausting to keep up with.
Absolutely. But it highlights how important it is to understand the political landscape, even if you're just focused on investing.
Right, because it's all connected.
Everything's connected.
All right, so we've got the U.S. dealing with this inflation puzzle and unpredictable political pronouncements. Let's hop across the pond to Europe.
Well, it's interesting because despite inflation also ticking up in Europe, investors are actually betting on interest rate cuts by the European Central Bank.
Wait, really? So they're going in the opposite direction of the Fed?
Seems that way, yeah. And some analysts think those cuts could happen as early as January.
So why would they cut rates when inflation is a concern? That seems counterintuitive.
It does. But the ECB is looking at the bigger picture. They see sluggish growth, weak consumer spending.
So they're willing to risk a bit more inflation in the short term, if it means boosting the economy.
That seems to be their calculus, yeah.
It's also like they're playing a different game than the Fed.
Different players, different game plans. And that highlights how these global markets, while interconnected, are also driven by very specific regional factors.
Okay, that makes sense. But even with potential rate cuts, there are still some storm clouds gathering over Europe, right? I read something about the UK bond market having a rough week.
Yeah, the UK is in a tough spot right now. They're facing this perfect storm of anxieties.
Like what?
Well, you've got concerns about spillover effects from Trump's trade policies. Then there's the Fed potentially raising rates, which could have ripple effects globally. And then you layer on top of that the UK's own domestic worries, like their debt levels and government spending plans.
So basically, a triple whammy of uncertainty.
Pretty much. And all of that has really shaken investor confidence.
And we see that reflected in those soaring bond yields.
Exactly. When bond yields go up, it's a signal that investors are demanding a higher return for lending money to the UK government.
Because they see it as a riskier investment.
Precisely.
Wow, we've barely scratched the surface of Europe, and it already sounds like a whirlwind.
And we haven't even touched Asia yet.
I know. Okay, let's take a quick pause here to process everything we've learned about the U.S. and Europe so far.
Sounds good.
So, the U.S. is grappling with a strong economy, but inflation worries and an unpredictable Fed.
Right.
And Europe is facing its own set of challenges, with the ECB potentially cutting rates despite rising inflation, while the UK is dealing with a whole bunch of anxieties that are rattling investors.
You nailed it. A lot to digest.
I know, right? But we're not done yet. Next, we're heading east to explore the markets in Asia, starting with Japan and those whispers of currency wars.
Right, so the yen has been sliding against the US dollar, and there are a few reasons for that. First, there's speculation that the Bank of Japan might finally start raising interest rates.
But they haven't actually done it yet, right?
Not yet, but the markets are always looking ahead, so even the possibility of a rate hike can move currencies.
Okay, so it's all about anticipation. And then there's also that talk about Japan intervening in the currency markets, right?
Yeah, the Japanese government has hinted that they might step in to try and stabilize the yen. They've done it before.
Currency manipulation.
Some people call it that. It's a bit controversial, but it's definitely something Japan has done in the past.
So the yen is a currency to watch closely.
Definitely. Now, let's switch gears to China. Remember, they're facing those challenges of slow growth and deflation.
Yeah, not exactly a recipe for economic success.
No, it's not. But there are some positive signs. Remember that uptick in services activity we talked about?
Yeah, that was encouraging.
It is. It suggests that consumer spending might be picking up, which is good news.
So maybe a glimmer of hope for the Chinese economy.
Maybe. And then you've got the People's Bank of China, their central bank, pledging to support the economy with what they call a moderately loose monetary policy.
Which basically means they're going to keep pumping money into the system.
Exactly. They're trying to stimulate growth, but it's a delicate balance. Too much stimulus could lead to inflation.
Right. It's a tightrope walk. Now, what about those two emerging markets we talked about, Mexico and Peru? They seem to be taking different approaches.
They are. Mexico seems to be in a pretty good spot right now. Inflation is under control, and they might even cut interest rates further. Peru, on the other hand, is being more cautious.
So two different stories, two different approaches. It just shows how diverse the emerging markets are, right?
Exactly. Each country has its own unique set of strengths and weaknesses.
It's like a mosaic, all these different pieces coming together to create a bigger picture.
I like that analogy, a mosaic of economies.
Okay, so we've covered a lot of ground here, from the US and Europe to Asia and emerging markets. It's a lot to take in.
It is, but hopefully now you have a better understanding of what's driving the markets, what the key risks and opportunities are, and what you can do to navigate this complex landscape.
Yeah, I feel much more informed now. But before we wrap up, let's talk about what it all means for the average investor, like me. What are the key takeaways for our listeners? How can they use this information to make smart financial decisions?
Yeah, that's a key question, isn't it? How do we make sense of all this and actually make smart decisions?
Because it's easy to feel like, oh my gosh, everything's out of control.
Absolutely. The market can feel like this big, scary monster sometimes, especially when things are volatile.
So help us out here. What's the first step?
First thing, take a deep breath and remember. Focus on what you can control.
Okay. That sounds like good advice in general, but what does it mean for my investments?
Well, you can't control what the Fed does or what Trump tweets or what happens with the yen, right?
Sadly, no.
But you can control your own investment strategy.
So like not freaking out and selling everything when the market dips.
Exactly. Panic selling is almost always a bad idea.
Okay, so no panic selling. What else?
Have a plan. A diversified plan that aligns with your risk tolerance and your long-term goals.
Diversification, we hear that a lot.
For good reason. Don't put all your eggs in one basket. Spread your investments across different asset classes, different sectors, different regions.
So if one area goes south, the whole ship doesn't sink.
Exactly. You're spreading the risk.
Okay, that makes sense. So don't panic, have a plan, diversify. What else can investors do to stay ahead of the curve?
Stay informed. We are absolutely bombarded with financial news these days, right?
24/7.
It's overwhelming. But you got to filter out the noise and find reliable sources.
Like Market Deep Dive, for example.
Exactly. They do a great job. But there are other good ones out there, too. Just do your research. Make sure you're getting information from reputable sources.
Okay, stay informed. Got it. Anything else?
Don't be afraid to ask for help. If you're feeling lost or confused, talk to a financial advisor.
Yeah, that's always a good idea. They can help you figure out what's best for your specific situation.
Exactly. They can create a personalized plan for you.
That's like having a financial coach in your corner.
I like that, a financial coach.
All right, so to recap, don't panic, have a plan, diversify, stay informed, and don't be afraid to ask for help.
You got it. And one more thing. Remember that investing is a marathon, not a sprint.
We've heard of that one before, too.
And it's true. Be patient, be disciplined, and focus on the long term.
Solid advice. Well, I think we've covered a lot of ground today. We've gone from the U.S. to Europe to Asia and back again. We've talked about everything from jobs and inflation to bond yields and currency wars.
It's been a whirlwind, but hopefully our listeners now have a better understanding of what's going on in the global markets and how it might impact their own financial lives.
Yeah, definitely. And even though things might seem chaotic and unpredictable right now, remember that there are always opportunities out there.
Absolutely. And by staying informed and being proactive, you can position yourself to make the most of those opportunities.
Well said. So keep learning, keep exploring, and keep diving deep into the fascinating world of finance. Until next time.